The American dream of homeownership is turning into a nightmare for many low-income families as they struggle to pay their mortgages. According to a report from Fannie Mae, the debt-to-income ratio on FHA mortgages hit 44% in 2022, the highest percentage ever recorded. This figure is even higher than the 2007-2008 housing bubble, and it spells trouble for the housing market. The housing market's in trouble, and a lot of people's brains will break when they read this. The conventional narrative has been that there's no more bad loans in this housing market, but that's not true. The U.S. government is subsidizing bad loans just like they did in the mid-2000s through the FHA VA loan programs, where low-income buyers can put only 3 to 5% down and get a mortgage that eats up nearly 50% of their income. This is saddling low-income families with huge amounts of debt, leading to lots of defaults and foreclosures. According to Fannie Mae, the debt-to-income ratio on FHA mortgages hit a record high this year, even higher than the 2007 to 2008 housing bubble. This means that a significant portion of low-income homeowners are struggling to make mortgage payments, and the default rates on these FHA loans are already very high, at an astronomical 13% of purchase loan borrowers in default currently. However, we haven't seen the foreclosures because of all the moratorium/forbearance programs which are now over or ending. The default rates are spiking in recent months, with the 30-day default rate up to 5.4% in February from 4.3% 1 year ago, and the 60-day default rate also going up. This is a sign of economic trouble, as FHA mortgage defaults are leading indicators for the economy. While not all of these FHA borrowers will be foreclosed on in 2023 and 24, most might end up selling their houses because they built up equity during the housing boom. But whether it's a foreclosure or a forced sale, it's still inventory on the U.S. housing market. For the dam to really break on mortgage defaults, the unemployment rate will need to go up, as historical data is clear. The unemployment rate and mortgage default rate are very correlated. Today's job report shows a still record low 3.5% unemployment rate. For now, the defaults will start occurring on FHA mortgages, specifically among those low-income borrowers who are most exposed and lose their jobs first. But if the unemployment rate goes up substantially in 2023-24, the defaults will spread across the housing sector because the entire U.S. housing market is being fueled by high debt-to-income mortgages. DTI for all purchase mortgages hit 38% in Q2 2022, most recent data, comparable to the peak in the mid-2000s. Despite all the talk about lending standards improving, it's not actually showing up in the data. Americans are still struggling to afford their mortgage payments. Certain things have improved in lending, such as credit scores going up and banks checking and verifying income when giving a mortgage, but that doesn't make up for the fact that DTIs are nearly 40%. This suggests big problems if people lose their jobs. Another scary statistic is that 34% of mid-2022 purchase mortgages were originated at a DTI above 44%, which is a very risky bucket of mortgages. This is similar to mid-2000s bubble and implies that defaults, forced sales, and foreclosures are coming. It probably won't be the $10 million we saw in the wake of the 2008 crash, but it could be $2 to $3 million, which would be enough to cause real problems. The housing market is crucial to the U.S. economy, and any downturn in the market can have a ripple effect across the entire economy. The current situation is cause for concern, especially for low-income families. The government needs to step in and provide assistance to those who are struggling to make ends meet. The situation is particularly worrying for low-income homeowners who are most exposed to economic downturns and job losses. While they may have built up equity during the housing boom, if they're unable to keep up with their mortgage payments, they may be forced to sell their homes or face foreclosure. If you're interested, you can download the data for yourself at Fannie Mae's website. The Excel spreadsheet is a bit hard to read, but you can look at AVE_DTI under Series ID. I'll leave the link in the description. Moving on, this is from Black Knight's Mortgage Monitor. 2022 vintage loans are the worst performing since the GFC. 2022 FHA loans have shown significantly higher early payment default rates than 2009 through 2019, with 2.3% falling delinquent within 3 months and 9.3% within a year. While the 2019 vintage showed higher 12-month delinquencies and 2020 showed higher 3-month delinquencies, these were directly related to the pandemic, and outside the pandemic impact, they exhibited flatter trajectories. Inflation and increasing interest rates are a double whammy for most Americans. The recent rate hike by the Federal Reserve has led to credit card annual percentage rates hovering at nearly 20%, and they're expected to climb even higher. Concurrently, more and more consumers are relying on credit to afford essential items like food and rent, leading to a surge in credit card debt. According to TransUnion's latest quarterly report, total credit card debt hit a record $930.6 billion at the end of 2022, reflecting an 18.5% increase from the previous year. The report also revealed that the average balance on credit cards rose to $5,805 over the same period. Bankrate calculated that if minimum payments were made towards the average credit card balance at nearly 20%, it would take more than 17 years to pay off the debt, costing an exorbitant $8,213 in interest. The latest debt statistics from America indicate that although anyone can face financial difficulties and fall into debt, younger individuals are struggling more and are becoming delinquent faster, particularly on credit card and auto loan payments. Delinquency rates among younger borrowers have surpassed pre-pandemic levels, while older borrowers are also seeing a rise in delinquency rates, but are yet to reach pre-pandemic levels. To get a better understanding of the non-mortgage debt that Americans have, let's take a look at the total amount of debt by age group, as well as the average non-mortgage per capita debt for each group. For 18 to 29-year-olds, the total non-mortgage debt amounts to $69 billion, with an average debt of $12,871 per capita. Those in the 30 to 39-year-old age group have a total non-mortgage debt of $1.17 trillion, with an average debt of $26,532 per person. The 40 to 49-year-old age group has a total non-mortgage debt of $1.13 trillion, an average debt of $27,838 per person. The 50 to 59-year-old age group has a total debt of $98 billion and an average debt of $23,719 per capita. Individuals in the 60 to 69-year-old age group have a total non-mortgage debt of $64 billion and an average debt of $16,661 per capita. Finally, for those aged 70 and older, the total non-mortgage debt amounts to $36 billion, with an average debt of $9,827 per person. It's evident from these statistics that younger individuals are burdened with higher levels of debt compared to older age groups. While debt issues are prevalent across all age groups, younger individuals appear to be struggling more and facing difficulties in keeping up with payments. Please subscribe. Thanks for watching. Until next time.